So everyone, we are looking at financial management, intermediate level, or for the students who are doing ATD, I think it should be ATD level 3. All right. And today we are looking at valuation. And the question that I would want us to focus on is this question, November 2019, question number 5C. November 2019, question number 5, November 2019, question number 5C, question number 5C. So it reads as follows: Virgin Industries had issued 72 million ordinary shares at 31st March 2019. So number of ordinary shares that I normally call knows there are 72 million shares. The company had maintained an annual dividend payment of 180 million, including for the year ended 31st March 2019. So the total dividend is 180 million. On 3rd April 2019, the management of the company was awarded a 4-year tender that would cost 720 million. So the tender, the cost of the tender is 720 million. So of course, that is what we shall be calling the initial outlay. So if they would want, ladies and gentlemen, in this case here, to take advantage of this tender and perhaps apply and do whatever they are required of it today, they must pay the 720 million. It's an initial outlay. Quite good of you to know that. The directors decided to finance the tender by issuance of ordinary shares at par. The return on investment was expected to be 25% per annum on the cost over the next 4 years, ending 31st March 2023. All earnings would continue to be paid out as dividends to the shareholders. The cost of capital is 20%. So they want us to give them the value of an ordinary share as at 31st March 2019. 31st March 2019. So remember, we are giving you this free of charge financial management tutorial from RCM Online College. RCM Online College has published great revision kits having CASNEB questions and suggested what-year answers, which are very helpful. They have been very helpful to many students over the number of years in terms of their revision. And of course, they will really help you to pass in your exams. They cost just 1,000 shillings. 1,000 shillings. And of course, if you are in need of them, you simply need to give us a call. Our school's phone number is 0719 525 1000. 0719 525 1000. So this is quite a very interesting question. So value of a share. How do we value a share? To value a share using the dividend valuation model, DVM, dividend valuation model, we know that provincial officer should always be equal to a district officer who grows in terms of rank. So we have here provincial officer equals district officer into 1 plus the growth rate all over Kenya minus government. All over Kenya minus government. These are very, very important formula. Very important formula. These are very, very important formula that all of us should be able really to do what here to master. Provincial officer. So PO is the value of a share. Market value of a share is the PO. We have DO. This is the current dividend per share. Current dividend per share. What they have given us here is the total dividend. So if I'm the one getting this, the first thing I'll do is to come and look for DO. So then DO, ladies and gentlemen, dividend per share will be equal to the total dividend provided, all over the number of ordinary shares. Total dividend provided all over the number of ordinary what here? Shares. Because DO is current dividend per share, not total dividend, not total dividend. It's current dividend per share. So then the total dividend here has been provided up here. It is 180 million, 180 million. Divide this by the nose. And my nose in this case is 72 million. My nose in this case is 72 million. So is there somebody who is able to give me their current dividend per share. Please write this in full. The DO does not stand for district officer. DO does not stand for district officer. That was just a moniker to enable us understand this thing even better. So I'm being given a figure of 2 point what here? 2.5 from Raphael. 2.5. Great. Bernard also has confirmed that 2.5 is the correct thing. Now, ladies and gentlemen, please remember, in this question, there is nowhere they have told us anything to do with what here dividends growing. Remember, this G stands for the growth rate of dividends. There is nowhere. Actually, in this question, what they did, they told us in the second sentence, they told us the company had maintained an annual growth rate of dividends. The company had maintained an annual dividend payment. So in this case here, if the dividend is maintained, there is no growth. So G is 0 here. G is 0 in this question. So meaning straight away then that our PO should basically be equal to DO all over what we call what here? KE. Because now growth rate is not with us. It's a stable model here. No growth model, 0 growth model. So G is nowhere. This G is nowhere because G is 0. Why is that the case? It is because the total dividend paid was maintained over the years. Even if they never gave us that statement, provided you are not able to see a statement where they tell you that dividend is growing, or provided, you see at times they may be silent on that, but they give you like 3 dividend amounts. Dividend amount year 1, dividend amount year 2, dividend amount year 3. If they give you like 3 dividends, then you must compute the growth rate yourself. So in this case here, they have not given us many dividends, and neither have they given us, in this case here, growth rate in the question. So straight away, we shall take that the growth rate in this particular case is 0. So if that is the case, then come and take the DO. The DO, ladies and gentlemen, the DO in the question that you guys gave to me is 2.5 all over KE that I called Kenya is cost of equity. So as this examiner really given me the cost of it, let's check around. Down there, if you're keen enough, they just gave us the cost of capital. That is what we shall use. That is what we shall use as cost of what here? As our cost of equity. We shall assume that this company is not financed through debt at all. It's an all-equity company. So the cost of capital 20%, that is what we shall take as our cost of equity. So our cost of equity is 0.2 in that regard. So then could you kindly give me the PO? Could you kindly give me the PO in this case? Could you kindly give me the PO in this case? So in this case here from Raphael again, Bernard, where are our ladies in this group? 12.5, right? 12.5. So this is correct. You earn your marks and then you go straight away forward with other things. So 12.5. So 12.5, that is what you were supposed to give us. So up to here, are we together? Up to here, are we together? Up to here, are we together? So as I wait for you guys to respond, my YouTube followers, please ensure that you subscribe to my channel. And most importantly, please leave a comment there. Tell us, for example, which other areas would you want us to cover in future videos? Give us a comment. I mean, give us a like. You need to promote this teacher to an international level. Don't benefit from my videos without really giving me a thumbs up. Thank you. So great. So in this case here, the response from the students that I have live here, what are they telling us really here? Are they comfortable up to 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 here? Great. That name is coming in a few minutes. The name is coming in a few minutes. So number 2, they want us to give them the value of the company as at 3rd April 2019, assuming that the management made a decision to undertake the investment. to undertake the investment. So this is an examiner who is wishing us success. So when he tells us, ladies and gentlemen, to provide value of a firm, how do we provide value of a firm? How do we provide value of an organization? So the value of the organization basically will be what we call market capitalization. Market capitalization. So value of the firm. Value of the firm equals market capitalization plus the net present value of future projects. Now, ladies and gentlemen, if you would want to know the value of Safaricom today, what you will simply need to do is to give us the market capital of Safaricom. And how do you get market capital of Safaricom? Currently, a share of Safaricom is going for 19 bob. Currently, Safaricom share is going for 19 bob. This is the market price per share currently. It has really come down. I don't know what is happening with our economy. It has really come down from highs of 40 to this kind of a low of 19. Actually, just the other day, it has touched 17. So we don't know whether it will really now increase. We don't know. There is quite a lot of turbulence in our economy. Great, but we shall overcome. That is not what I am here to talk about. So the market price per share today of Safaricom is going for 19 bob. And then we know that the nose of Safaricom has got 40 billion shares. No stands for number of ordinary shares. Is what your normal? No. Number of ordinary in finance. Nose is number of ordinary shares. So then if you would want to get to the total value of Safaricom today, what will you do? Market capitalization. And to get market capitalization, you simply take the market price per share of a company multiplied by the number of ordinary shares of that company. So then for Safaricom, this will be 19 times 40 billion. Can somebody give me this answer? What are we getting? 7.6 trillion. Oh, sure. $19 times 40 billion. Can somebody in this case give me this answer? Someone else. Should be less. Yeah, 760 billion years. Should be 760 billion. 760 billion. It has never gone. You know, even the other day when it was about 40, it was 1.6 trillion value of Safaricom. All right. Thank you very much. So it's shy a few coins, a few billions to a trillion. Quite a high, valuable organization. A highly valuable organization. That is not the concept that I would want to teach you today. What I wanted to teach you today is regarding this question that we're doing here, where they want us to give them value of what here? Value of a company. And fortunately, we can easily do this market capital of this organization. The market capital of this organization, we know it is market price per share. Market price per share of this question that we are doing. In part one, we had obtained the market price per share. Is there somebody who can remind us what the market price per share was? Is there anybody who can remind us what the market price per share was? Yeah, 12.5, isn't it? So it is 12.5 per share times number of ordinary shares of our company. Is there somebody who remembers that the number of ordinary shares of this company was 72 million? Is there anybody who can be remembering this value? 72 million. Is there somebody who can remember 72? Yes. Thank you very much. Now, from there, then we need to ask ourselves, is there any project that these guys are going to commit onto in the near future? If there is any project that these people are going to commit onto in the near future, then the NPV of that project will have an impact on farm value, So, So like in this question of ours, let's see whether there is any immediate project that these guys are going to engage in. We are told part C, for the students who have just joined us, this is November 2019, question number 5C, November 2019, question number 5C. So we are told here Virgin Industries had issued 72 million ordinary shares as at 31st March 2019. The company had maintained an annual dividend payment of shillings 180 million, including for the year ending 31st March 2019. On 3rd April 2019, the management of the company was awarded a 4-year, so N is 4, number of years are 4, was awarded a 4-year tender that would cost 720 million. The directors decided to finance the tender by issuance of ordinary shares at par. The return on investment, what we call ROE, was expected to be 25% per annum on the cost over the next 4 years. Ladies and gentlemen, generally, how do we get ROE? How do we get return on investment? To get ROE, we normally take profit before interest and tax all over the investment. Profit before, actually this one here does not even have issues to do with interest and tax. Just talk of profit. It's profit all over investment to get ROE. So, and they have given us ROE in this case is 25%, which will be equal to the profit whose amount we are looking for all over the investment. We are told that the total investment into this project is 720 million. 720 million. So is there then somebody who can give me the profit amount? Is there somebody who can give me the profit amount in this case? Is there somebody who can give me the profit amount in this case? In this case, the profit amount, make profit the subject of the formula. Make profit the subject. If we make profit the subject of the formula, then my profit will be 25% times 720 million. Times 720 million, which will end up being equal to what? Here, somebody, they are not talking to me this morning. 25%. So somebody is telling me that this will be 180 million. 180 million. Thank you so much. 180 million. This basically is an annual profit like that. Now, ladies and gentlemen, remember, you must have been told this by your respective teachers, that whenever you are not given taxation in a question, whenever you're not given tax in a question, when a question is silent as to the taxation rate, then whatever profit you have, automatically it becomes your cash flow. So like in this question, there is nobody who has told us that the tax rate is 30%, tax rate is 20%. So in this case, here, ladies and gentlemen, the tax has not been given. And in finance, whenever tax is not given, in finance, I'm repeating this, whenever tax is not given, profit will be equal to cash flow. So basically, this is the cash flow per annum. 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 And because we would want to discount this and basically get NPV, net present value, then this is the model that I'm going to use. That my net present value will be equal to 180 million, And because this 180 million is a repetitive figure, is an annuity figure, then I'll come and multiply this with our PV, 20%. For how many years are we going? The project's lifespan was given to us as 4 years. And then once I do this, I'm able to get the total present value. Future cash flows discounted. I'm able to get the total present value. Then I'll come here and subtract the initial outlay. The initial outlay, which was what here, somebody? 720 million. So remember from the ROE formula, the profit here is an annual profit. So this profit that we got here is an annual profit. So whatever we have is an annuity of 180 million, which I'll receive in year 1, year 2, year 3, year 4. So because it's an annuity, then I'm using PVFA to discount. It will be present value interest factor of what year? An annuity. Where did I get the 20% from? Up there, they gave us the cost of capital. They gave us the cost of capital up there. 4 years, this automatically represents what year? The number of years, the number of years, the number of years, the number of years. So is there somebody who can go to their tables and then they read this 20% 4 years? The annuity table. Remember, you've got 2 tables, discounting tables in our exams, which shall be given to us. We have the lump sum, and then we have the annuity table. So from the annuity table, is there somebody who can read for us and give us a figure from the annuity table? From the annuity table. Alternatively, remember discounting, how discounting looks like. How discounting looks like, we have in this case here discounting for lump sum. Discounting for lump sum is PV. And the PV, we normally talk of 1 plus R raised to negative n for discounting lump sums. And then we have got discounting of annuities. So discounting of annuities, we talk of PV, which will be 1 minus this. 1 plus R raised to negative n, and then everything to be divided by R. Everything to be divided by R. Everything to be divided by R. So then, ladies and gentlemen, if that is the case, our PVFA will be 1 minus 1.2 raised to negative 4 divided by R, which is 0.2. I'm so sure somebody here has not seen how I got 1.2. I got 1.2 because R is the return. R is the cost of capital. And this cost of capital has been given to us as 20%. Cost of capital has been given to us as 20%. So it will be 1 plus 20% the same as 0.2. So it will be 1 plus 0.2. So that is 1.2. So then this will be 1 minus 1.2 raised to n is the number of years, raised to negative 4, raised to negative 4. And then, of course, I'll say equals there. Whatever I get, I say divided by 0.2. What figure are we getting, somebody? Somebody now help me out. So in my calculator, I'll say it's 1 minus 0.2. 1 minus 1.2, I mean, raised to negative 4. And then I divide by the cost of capital R, which is 0.2. I'm not seeing my students giving me figures. I'm not seeing my students giving me figures, really. I'm not seeing my students giving me figures. Ah, they're here. It is 2.5887. 2.5887. 2.5887, like that. Thank you, and thank you so much. Please ensure that you are able to use your calculator very well. If you don't know how to use your calculator to get these things, you'll always be in problems. How do you do this? You will say 1 minus, open brackets, 1.2, you close. Don't say equals. You simply say here raised. Raised in your calculator, raised looks like this. In your calculator, raised looks like this. Raised looks like this. Raised looks like that. Raised to. And then once you've raised like that, after you said equals, then you'll come and divide this by 0.2 like that, divided by 0.2. So then you are right. So then the net present value will be 180,000 here, 180 million, I mean, times this PV of 2.55887 minus 720 million. So is there somebody who can now give me this figure? Is there somebody who can give me the net present value? Is there anybody who can give me the net present value here? Anybody who is able to give me the final net present value? The final net present value. The final net present value. So according to UCIDE, it is minus 254, minus 254, minus 254. According to UCIDE, it is minus 254, minus 254, minus 254, 034, minus 254, 034,000, minus 254, 034,000, minus 254, 034,000. So in this case, I'm being given a figure of minus 254, 034,000 like that, which really eats onto the value of the farm, the value of the farm. So in this case here, should they insist Should they insist and say, hey, in this case here, let's just go ahead and invest there, then the value of the farm will be negatively affected. The value of the farm will be negatively affected. But otherwise, in this case, if I'm the one making decisions here, I'll go ahead and say, I reject this project, and therefore the total value of the farm will remain like this. Total value of the farm will remain like that. So listen and listen to me very well for us to be able to summarize this nicely. For us to be able to summarize this nicely, what do we have here? So for us, we are rejecting. But because the examiner wanted us to provide the total value of the farm with the project, then if they choose to accept the project because of other underlying maybe benefits, if they choose to accept the project, the value of the farm, will be this. If they choose to affect the value, to accept the project, then the value of the farm will be this market capitalization minus the 254, 034,000, like that. They are going to suffer. The value of the farm will reduce. The value of the farm will reduce. Somebody wants me to explain why we are deducting the 720 million. Remember, the 720 million is the initial capital for the project. We were told in this question here, on paragraph number 2, on 3rd April 2019, the management of the company was awarded a 4-year tender that will cost 720 million. So the tender's cost is 720 million. That is the initial outlay. I hope that is clear to you. So if they go ahead and accept the project, which we have told them here, hey, don't accept the project because the farm value will go down. If they go ahead and accept the project, then what will be the total value of the farm? Would you kindly give me this value now? These guys are not giving me these figures. Simply take 12.5 times 72 minus that figure, give us a figure. So according to Maria, according to Bernard, it is 645, 966,000, like that. But of course, you and I appreciate that it's always bad manners to accept projects whose NPV is what here is negative. If you accept projects whose negative NPV, with negative NPVs, then the wealth of the shareholders will be reduced. Now, so if I'm the one doing this, I'll come again, tell them that if they do not accept the project, if they don't 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 accept the project because the NPV is negative, then the value of the farm will be the market capitalization, like that. And then you are through with this question. So could you kindly, because the NPV now here will be 0. The NPV will be 0 there. Then if they don't accept, could you kindly give me a figure to write down here? Kindly give me a figure to write down. So we have kindly give me a figure to write down. If they choose not to accept the project as per our advice as their finance managers, because as finance managers, we have computed the NPV of this tender project and we have realized it's negative, and we are telling these people, no, don't accept. If they choose not to accept, then there will be no NPV coming as a result of it. There will be no new project. So if they choose not to accept the project, we shall only work with the market capitalization, which is coming to 900 what year? 900 million, and then you leave that question like that. Leave that question like that. So ladies and gentlemen, this is a very important concept that I wanted to bring to you, which I believe that it has been able to add some great value to you. Of course, we shall continue doing what here? Engaging. But most importantly, remember, we are giving you this free of charge tutorial from RCM Online College. So RCM Online College basically is a virtual college, 100% virtual college. We don't believe in physical classes. All our classes are done through Zoom, and of course we record our sessions, which students then will be able to make reference to, and of course be able to understand when they keep on watching these videos severally. So, and our courses are quite affordable. We charge per subject, we charge Kenya shillings 4,000. So if you're interested in this case here in signing up with us, please get in touch. This is our number, 0719-525,000. And my name is Dr. Joshua Aura. I teach financial management. I teach advanced financial management. I teach advanced financial reporting and business data analytics at RCM Online College. Otherwise, thank you very much. Bye-bye. See you another time. And don't forget to subscribe to my channel.